Hey, Professor Mike. What are we learning today?
Hey there, it's Professor Mike again, and today we're going to be talking about prepaid expenses and supplies. We're going to start off actually, because we're in the adjusting section of our course together, asking why would we adjust the accounts anyway? Why bother? I mean, we could just leave them the same, it's fine. Now, if you think back, remember we said that what we wanted from our financial statements is for them to talk to us, for them to give us accurate information so we could make good decisions, right? If we don't adjust the accounts, how could we trust them? We couldn't, because they wouldn't be accurate. We need them to be accurate. So some of the issues I want you to think about around adjusting. How about timing issues? So you've got an accounting time period. If expenses or revenues are happening outside of that time period, extending beyond that time period, or if we don't know about them while that's happening, but we actually incurred them in that time period, because we want our financial statements to be correct and complete, we want to make sure that we take those into account. We also want to understand that, revenue and expenses need to be recognized in that time. Those are some basic accounting principles. So there's a bunch of different types of adjusting entries. Today we're going to be talking about prepaids and supplies. We've also got depreciation and unearned revenue and accrueds, even though I know many of you think accounting in general is accrued. Anyhow. So the economic life of a business is going to be divided into these different time periods, right? Usually a month, a quarter, or a year. And in those time periods, you may choose to generate financial statements so you can listen to them and they can tell you things. And if you're going to generate those financial statements, you need them to be accurate for that time period, which means you're going to have to adjust the accounts. So a period of 1 year is called a fiscal year. Less than 1 year are called interim periods. And so if you were accounting on a cash basis, which you shouldn't do, you would just book revenue when you got the cash and book expenses when you paid them. Which doesn't make sense. That's not actually when you're using them. So revenue recognition principle says that generally when something is done, when the service is performed or the goods have been sold and delivered, that's when you recognize the revenue. And the flip side for expenses, same idea. When you actually use the thing that you're using, regardless of when you pay for it, that's when it should be expensed, which I think makes a lot of sense, and I hope you do too. So let's talk about prepaid expenses. These are costs that are paid in advance of receiving their benefits. They're recorded as assets because what we've done is we prepaid, so we've traded cash for the promise of something in the future. That might be for something like, supplies. We bought a bunch of supplies. Now, of course, let's say you own a business and you need to print things off. You're not going to go out and buy paper by the sheet, right? No, you're going to go out and you're going to buy a box of paper. And as you use up that paper, you want to expense it. Wouldn't make sense to go out and buy a single staple from Staples. Yeah? Of course not. So these are assets because we're giving up an asset and we're receiving an asset. And as we use up those assets, they become expenses. So when we buy supplies, we've got supplies. As we use up those supplies, it becomes supplies expense. Our assets go down and our expenses bring equity down. We're back into balance. Now, these costs are either through usage or through the passage of time. So for something like insurance or maybe prepaid rent, as time goes by, we're using them up. Whereas supplies, you would expense them when you actually use them. Let's do an example to see if we can figure this all out. On January 1st, 2021, a company purchases an insurance policy that covers 3 months and costs $1,800. So January 1st, the policy is going to benefit the company for 3 months. January, Feb, March. 3 months, right? The cost of the policy should be spread over the time period for which it benefits the organization, right? Because of the matching principle. So we want to actually match it to those time periods. So if you built a set of financial statements at the end of January, let's say, you would actually want to have insurance represented appropriately there. So you paid $1,800, can't expense that all in January because you're only using 1/3 of it. And 1/3 of 1,800 would be, I'll give you time for the tough ones. I'll give you a hint. 600. Yeah, no, you got it. Perfect. 600. I could hear you speaking to me through the computer screen. Well done. Okay. So we want to actually book that on a month-to-month basis if we're making financial statements in that time. So to record the insurance, if we were recording the purchase of the insurance, what are we paying for the insurance? We're paying cash. Absolutely. So that's one of the accounts. And the other account is going to be prepaid insurance. So cash and prepaid insurance. Excellent. Okay. So we're going to debit an asset, so it goes up. Remember, prepaids are assets. So we're going to debit prepaid insurance, and it's going to go up, just like this. And then we're going to credit cash because we paid cash, which is going to make assets go down. So here we are, goes up, goes down, and we're back in balance. Always want to be in balance through the accounting equation, and that'll make sure that our balance sheet's in balance as well. And so that's going to be our entry to record the purchase of the insurance policy. We start with the date, January 1st, and then we work our way through from there. So, okay, well, the policy was purchased January 1st. Here's that entry. Next up, if we're doing financial statements at the end of January, the insurance needs to be brought forward to that point. So at that point, we're going to expense some of the insurance. 1/3 is that $600 we talked about. So we're going to expense $600 worth of insurance. What's the other account? If we're debiting insurance expense, we're going to have to credit an account. And the account we're going to credit is that asset we're using up. And remember that asset's name was prepaid insurance. And so we debit insurance expense and we credit prepaid insurance on January the 31st to the tune of $600. Now, supplies and prepaids are very similar. Let's take a look at a supplies example because this is going to work a little different. This isn't expiring over the passage of time. This is actually looking at usage. So the company's year end is December 31st. During the year, the company buys supplies on 4 occasions. So they buy supplies all through these 4 occasions. March, June, September, and December. And they buy how much in supplies? $3,000, $5,500, $9,000, $12,000 in supplies, right? Over the year. But they don't expense them. That becomes the supplies asset. Now on December 31st, they actually do an inventory of their supplies and they check them and they realize they only have $1,800 left. That's what on hand means. They have $1,800 of that $12,000 left. So what do we have to do for an adjusting entry? It has something to do with those two amounts. So supplies is sitting at $12,000 right now in the books. Is that fair? Of course it's not, because we know they only have $1,800 worth of supplies there. So it would be unfair. It would be overstated if we left it at $12,000. We need to decrease that and expense some of it. How much do we need to expense? Well, if there's $1,800 left and we had $12,000, we need to expense the difference between the two, which in this case is $10,200. That's going to be supplies expense. Again, here we are, debited $10,200, and we're going to credit supplies, the asset. Absolutely. We're going to credit supplies, the asset. We're bringing that down. So we'll be back in balance. We're going to bring down those equity accounts by bringing in an expense, and we're going to bring down the asset accounts as well. And then back in. So now we're out of balance here, and then we're back in balance. Always want to remain in balance as an accountant and as a dancer as well, but that's a story for another time. So let's take a look. Here we are. To adjust the supplies, here we go. We got our date here. Well, this is going to be December 31st, obviously when we're going to be building those statements. We debit supplies expense, just like we had said, and we credit supplies $10,200. Now, on the balance sheet, instead of showing $12,000 for supplies, which is incorrect, we're going to show $1,800. That's absolutely right. We're going to show $1,800 because that's what we actually have. Well, I hope this has helped you with supplies and prepaids. Take care. Bye now.